Yo, what is going on YouTube? Today I wanted to make a video and just break down some of the recent ETF launches and go into how different financial institutions or providers of these ETFs often will do things like have cheaper or lower expense ratios on funds that effectively copy one another. And there's a few recent cases of that, and we'll jump right into it and explain why. So without further ado, let's get into it. So let's break down what actually occurred. So on July 9th, BlackRock, which is a major financial institution, launched their own copy of a NASDAQ 100 ETF. Basically, they copy and pasted QQQM. Now, why the heck did they do that? They did it to attract investors to their version of QQQM instead of Invesco's, who is the provider of QQQM. And it is simply to draw retail investors away from Invesco and kind of mess with their market, if you will. Now, one of the biggest ways that financial institutions are able to get away with this and why they do it is because they charge investors a smaller expense ratio on their ETF. So in this case, BlackRock is charging a 0.12 expense ratio versus QQQM's 0.15. So you save a little bit of money there, right? Which is great if you're a long-term investor. But as I said earlier, this is a common thing that happens at least a few times a year with all different kinds of ETFs and these financial institutions constantly fighting with each other for overall market share in the stock market. Now, if you're like me and you manage your own portfolio and your own investments and do all that wonderful stuff, you may be saying, hey, this is a fantastic opportunity to save a little money each year and to switch and rebalance my portfolio. However, that's not always the prudent move in these sort of expense ratio fee war cases, right? And we've seen this actually historically with VOO. So for a little history lesson for everyone out there, in 2010, when Vanguard launched VOO and Chill, the only other S&P 500 ETF in the market was SPY, which is instituted by State Street, right? And at that point in time, now this is going back years now, SPY was charging a 0.2% expense ratio, which is pretty steep. And Vanguard basically just said, hey, well, we're going to go and get the most market share and go launch a better S&P 500 ETF, and that's exactly what they did. And the way that they went out and did that was they charged a 0.03% expense ratio, which is basically free, right? It's not actually free, but super cheap for us small-time investor kids, as they say, right? Now, while I was still, hanging out in my PJs and playing like Call of Duty when this was going on, many people switched from SPY to VOO, which, again, if you're selling anything in a taxable brokerage account, you're going to have to pay big old Uncle Sam some taxes, which they were taxed on 100% of the appreciation. So think about it, if you've been holding it for 10, 20, 15, whatever years, right? I can't really count apparently, but that is a pretty big tax bill to only save yourself marginally, but still in the long run of your investments, it's not really a prudent move. So effectively, people paid a lot more in taxes to save themselves a marginal gain, if you will. It's not really a gain, but to save yourself a little bit in fees, which is ultimately not a very strategic long-term move. Now, just like with VOO and SPY, IQQ, which is BlackRock's version of QQQM or QQQ, is following suit and doing the exact same thing that history has shown in the ETF space. So thinking through this myself, right, I may not be one that wants to rebalance or sell my shares of QQQM and trade those in for IQQ right now. However, there are some cases where it does make sense to rebalance. So if you're brand new, early in your 20s, only have a small position in a NASDAQ 100 ETF, right, it may make sense to go ahead and do that and just kind of take a small gain or a small loss, right? As long as it's not hundreds of thousands of dollars, right? That's probably a fair and prudent move. The other exception would be if you hold this in a Roth IRA. That's an easy, quick swap. Takes 2 seconds to put a sale order in and then swap into a lower cost product. That's a layup. Now, before you do any selling or rebalancing, always take the time, do your research, understand the implications of the move, even if it's something as straightforward as just buying a cheaper version of the thing you already own. But I would take the time to do some research and appreciate some of the nuances or differences between the two products. Have a look. The other and kind of final thing I'll try to put a bow on this here is ultimately at the end of the day, the expense ratio or fees game, it's basically a race to the bottom, right? So there's a pretty good chance, may not happen this year, time will tell, that Invesco will likely slash their fees to keep those retail investors invested in QQQM, right? They want to keep that business and keep that market share. So sometimes it's just a matter of being a little bit more patient and kind of just waiting it out rather than just reacting to a headline or a news article about a cheaper alternative to the thing you already own. And it's likely going to happen throughout our lifetime many times over, right? This isn't the first time it's happened, and it sure as heck won't be the last. And ultimately, we benefit from the fact of these institutions fighting for this market share. Eventually, something's got to give. Financial institutions will lower their fees to keep your money with them. We'll see how long that takes. Sometimes there's a little bit of hesitation to do that, but this is kind of one of those subtle details where I think it's important to understand that sometimes patience is more prudent, and taking the time just to understand and look at the bigger picture of what's really going on in the market can help benefit yourself and keep your money moving and growing each and every single day. So cool. So as a friendly reminder, this is not financial advice. Always do your own research, but maybe this helps you start thinking about the different kind of ETF products that are out there, understanding a little bit more of why institutions do these things. See you next time.